go ahead and get started. Oh, there we go. One more person coming in. Okay, so thank you guys for coming. My name is Rick Albert. I work with Lamerica Real Estate. I'm a real estate broker. I'm also an investor here in Los Angeles, as well as what's called a house hacker. So one of my specialties is I buy homes, rent out the other rooms to kind of offset the cost. What I have here today, and this is the first time we're doing this, so I appreciate you guys all joining, is Jonathan Kim with Guaranteed Rate. He's a mortgage officer. John, I don't know if you have anything you wanted to say.
No, that's great. Thanks for hosting, Rick.
Awesome. Okay, so for those who have questions, we're going to try to get to a Q&A at the end. So if you have any questions, go ahead and post it in the chat feature that's at the bottom of the screen, and we'll get to as many questions as we can. In the meantime, we're kind of break this up into a couple different things. One is if you are a homeowner and a borrower, what are your options? Because that's really important. Two, if you are thinking about buying or in the process of buying, what are your options? And then I will do a quick kind of like history as what's happened in the past when we've had odd events, recessions, things like that, as well as what's going on in the market today. So why don't we just jump right into it? And we will go with the first question is, you're a homeowner, you're a borrower, you're in trouble, you can't make your payments, you've lost your job, anything like that. What are your options?
Yeah, so like Rick said, this is kind of general information. The thing about it is it's tough times for everyone out there, and one of those options is forbearance. One of the things that you got to keep in mind is like, what's the definition of forbearance? I guess that's the first question. So when I speak, you can think of the lender and the servicer as synonymous people. Just thinking of it as the people sending you the bill every month for your mortgage. But a forbearance agreement is basically an agreement between the lender or the servicer and the borrower and who's experiencing the hardship, right? And basically that agreement is to reduce or suspend, payments over a specified period of time. The lender will agree to not exercise legal rights like, show non-payment on your credit report if you let them know that you entered in forbearance. It's highly recommended that you get those details in writing when you call your servicer. But specific options are going to come from the servicer itself. So, the number that you see on your mortgage statement, that's the number you should call, and you should ask them. They more than likely they probably set up a hotline already because a lot of people are in this situation to discuss what your options are. I think it's key to note. The one thing that may be misrepresented is that it's not free money. It's not a payment waiver. It's not payment forgiveness. That money will need to be paid sometime, some way, somehow. It's just a question of what your options are to make that paid. I think the second thing, if you were to take away from this, from this webinar, is if you can make the payment, you should definitely try, because right now there is not really guidance as to what happens if you go into forbearance and what that could mean for your ramifications for future purchases, or what that would mean if you had like a waiting period. So at the end of the day, kind of the country's counting on you too, because if you can make the payment, try to pay it, because if everybody goes into forbearance, then we're going to have a serious issue in our hands as a country, in and of itself.
Okay, so because part of the issue with the forbearance, I don't want to say issue, one of the fine print is, let's say you do forbearance for 3 months, now you have a balloon payment at the end of the 3 months. Is that correct?
Right. So, the servicer is going to give you options, and depending upon your loan situation, how that repayment is going to happen is going to be dependent upon that servicer. It was really good advice, Rick, that you said that the situation is constantly changing, and that actually just occurred yesterday. Was Fannie Mae, Freddie Mac, yeah, FHA, everybody, there was a lot of bad press that, after the forbearance period, would you have to pay a lump sum? And nobody was ruling it out at the time. So the CARES Act, though, for those conventional loans, they put out literature yesterday basically saying that a lump sum payment after forbearance period is over, it won't be required. So, obviously, again, you got to talk to your servicer specifically to work out what it is that they're going to want to do. It's going to either be a repayment plan, You can do the lump sum if you want to, or a loan modification.
Got it. Okay. So for the loan modification, what would be an example of that? Is that just extending it from 30 years to 40 years? Is it just changing what the payments are to try to catch up?
Yeah, exactly. A loan modification is exactly what it sounds like. So when you first got your loan, you probably got a set of documents that are 100 pages long that you probably didn't read, but they outline the terms of your loan and every amortization schedule, the interest rate, if it's a fixed, if it's an ARM, the length, which is usually 360 months. But you're exactly right, Rick. The loan modification could modify any one of the terms of that loan. So one of the common things, like you were saying before, is that they could try to go to 480 months versus 360 in order to spread out those payments to a reasonable place.
Got it. So, like for example, I have clients where when they contacted their lenders, some did the forbearance option, some did, hey, just take the 3 months and add it to the end of the mortgage program or loan term. So how come they had that option and not everyone else?
Yeah, the reason why is that the servicer is going to look at your situation and your loan, and because all loans are different, all the terms are different. What a loan officer does is put you in a loan that best fits your suitability. Every loan has different risks. Every borrower has different risks. So what the servicer is trying to do is come to a happy medium, right? What they're trying to do is, one, look out for their investment, the money that they gave the borrower to buy the home, to make sure that that can be repaid in the future, but also two, to make the payment affordable, to make sure that they come back payments on time. So, a good servicer is going to find that happy medium that fulfills the requirements for both parties. The loan is paid back, eventually, as it was agreed to, or will be agreed to, and that the borrower has the ability to repay. So, sometimes it seems like that maybe oh, they're kind of working against you if they don't give you the options, but they're trying to protect their investment just as much as protecting you. So, working with the servicer to understand all the options out there, definitely pick the one that is going to benefit you the most and make it the most realistic thing. Just know though, like, asterisk and full disclosure, yeah, you definitely get everything in writing and make sure that you know exactly what you're getting yourself into, because it's kind of uncharted territory right now. I just looked at a loan for a loan modification on a client yesterday, and they basically took the amount she was behind and put a second lien and reduced the principal loan amount on the first lien. So she's just paying the first right now at a lower payment, but then on the title report there is a second mortgage basically that's on hold, not being paid, but eventually will. So it could be a number of different details as to how best to modify it for that particular situation.
So to clarify, those, we'll call it 3 months, instead of having to pay it back at the end, it just became a second loan where that will have to get repaid at some point.
Yeah, that's what I saw yesterday. So, this borrower came to me, and she was saying that she went through the '08 crisis, and that's when she got her loan modified.
Mm.
So we gathered the title report, and yeah, she doesn't make a payment on that second, but if she sells or refinance, it would have to be paid in full. So at the end of the day, yeah, it's that there's going to be many different options of which that servicer is gonna give you options for, and it's just definitely take your time. Don't rush anything. Know exactly what you're doing before you do it.
Got it. Okay. And then is there any difference between if you're a primary residence or if it's one of your rental properties? Is it still just case by case, or are they more likely to work with your primary residence? Like what have you seen there? If
Yeah, these are these are going to be normally primary residences, because the government is more interested in making sure people can stay in their home. So yeah,
okay.
yeah, definitely.
Okay, so as a whole, how is this affecting the mortgage industry? Because one thing I've been hearing, and one of the big concerns is if, for example, Guaranteed Rate or whatever bank, they sometimes sell the loans That way they get their money back to give out more loans. But then if everyone goes into forbearance, the servicer, or now who actually took over the loan, still wants to get paid. So I've heard that some people in the mortgage industry are kind of freaking out. So what have you been seeing as a whole for the mortgage industry? Are they concerned that it's another 2008 crash, or what are you seeing?
Yeah, so I don't know if it got the press that it deserved, but maybe like 2 or 3 weeks ago, if you guys remember, like there was big announcements that the Fed, injected like $2 trillion into the system. So to answer that question, let me give you a little background because it's kind of complicated. Basically, the wheels have to spin. So the mortgage industry, or every business out there, money has to move. It's kind of like water. If it's stagnant, it dies. Um, Basically what happens is that normally and typically in every loan that ever occurs, they get packaged exactly like you said. They get sold to a servicer, and then they're sold on what we call the secondary markets. So what was going on during the COVID crisis was that nobody wanted to buy these loans, and it literally was grinding the liquidity to a halt. There was no more money to lend. So what the government did and what the Fed did is they basically stepped into Wall Street and they said if nobody wants to buy home loans, it's a bad situation. We're going to become the buyer. So it was nuts for a good 2 or 3 weeks where rates were going nuts. Sometimes they were increasing like up into the fours, but then when the Fed came in, they really inspired and put a lot of confidence back in the system that the Fed will do everything and everything they can to make sure that the mortgage wheels are turning. So they avoided a disaster, and that's pretty much the sentiment on Wall Street. And like I said, yeah, the Fed really saved the entire economy. So I think in terms of like an '08 crash, I don't think that is kind of the feeling on in the mortgage industry right now. Right now, there's plenty of liquidity because the Fed stepped in.
Mm-hmm.
Rates have come down because the Fed has stepped in. And it seems like things are in control. Like rates were going up and down, changing it like 3 times a day sometimes. And now it's pretty much stabilized because I think pretty much people think they know what's going on. Seems like Wall Street has a, good, the stock markets are going up, every day too. So there's a lot of confidence that maybe we're, seeing the light at the end of the tunnel.
Nice. Okay. So let's kind of switch gears a little bit to the buying. And I see people posting questions. That's awesome. We will get to them at the end. But I do appreciate you guys posting them. So just so you know we're seeing it. So the big news that hit on the buying side, and it might actually also affect refinances, you'll hopefully be able to help with that, is that Chase now is requiring 20% down and a FICO score of 700. Is that something that all banks are requiring? Is that just because Chase is one of the larger loan servicers, or
Yeah, that's really funny. We don't have anything like that, and I'm not sure. Maybe because Chase is a bank and they do lots of other things than mortgages. But what they're doing basically is they're trying to protect their investment. So you just gotta think about it if it was your money, right? Let's say you had $1 million in cash, and you gave 500,000 to your brother, your sister, your friend, and you want to make sure you get your 500,000 back plus interest.
Mhm.
So what they're doing is they're tightening restrictions to make sure that they're putting themselves in the best possible place where they have a good and warm and fuzzy feeling that they're going to get their money back, right? Because if somebody were to go into forbearance or um, to foreclose, that's bad for everyone. Everybody loses. The buyer loses, the bank loses, everybody. Everybody loses. So we've had some what we call overlays. That's what they're called in the industry. They're basically just more stringent rules. Nothing that nuts. Like you can still do 5% down loans. As long
The
as the loan
58
amount.
loans, the FHA loans.
Yeah, exactly. I think the most stringent thing I've seen is if your FICO score is a little lower, what they'll probably want to do is have you hold cash after the transaction's closed, make sure that you had some kind of liquidity in
Okay.
case something were to happen. But for the most part, guidelines are guidelines, and these overlays are imposed by, like, the mortgage company just to make sure that they get a warm and fuzzy feeling that nobody's gonna foreclose anytime soon.
Yes.
Um, but yeah, that's kind of nuts. But we're doing those all day long.
Got it. So for the most part, the home buying process is about the same. It might take a little bit longer, but it's still happening.
Yeah, so I think people right now who are in escrow or who are doing a refinance, they're frustrated more than likely. I'm not gonna lie. What you have is this unprecedented surge of refinances that came through because rates were dipping so low at one point in time.
Mhm.
Like the lowest I seen, we closed one at like 3.25, you know, and
Wow.
then yeah, it's nuts. And then you have so many refinances going through the system that that's what's causing this liquidity problem because the investors who buy those loans are anticipating that they're going to get a return on that investment. But if these refinances close those loans out, then they got a problem.
Mm,
So, yeah, it's that kind of situation. But like guaranteed rate right now, like purchases are always are going to be prioritized because they're under contract. They, in order to meet contingencies, and Rick, you know all about that stuff, is
yeah.
making sure loan contingencies are good, appraisal contingencies, like hitting those milestones is extremely important. So, refinances are going through the system a little slower, but it should be prioritized that purchases are going first.
Okay. And that makes sense. What I have been hearing um, is some of the lenders are saying, hey, the day before you fund, they're gonna have to re-verify employment again. Have you been
Yeah.
seeing that?
Absolutely, yeah. That's standard now on every loan is like when it gets to closing. So usually the typical way a loan works is you get your application, you get the documents, it goes to the underwriter. Underwriter issues what's called a conditional approval. That's
Mhm.
saying, hey, your loan is good as long as you can fulfill the rest of these things. And usually it's like 3 or 4 items. And then it goes what we call clear to close. The loan is finally closed out. Well, because people are losing their jobs at such a rapid pace right now, at closing, like what we're doing standard is we're asking for one last pay stub or calling the employer one last time to say, hey, you're still employed, right? Nothing's changed. Because there have been cases where people lost their job right at closing, and you know here's the thing is that it seems like a lender's a bad guy because they remove the loan, right? They withdraw that loan application, but it's to protect their investment, but it's also protect yours. You don't want to be locked into something that you can't pay back. And as soon as this thing's over with, everything will probably just go back to normal the way it normally is.
Right. And on the real estate side, there's a new form that we submit with offers, basically saying, because normally you have contingency dates, right? So I call them subject to. You're going to buy the house subject to inspections, whatever loan, and normally that might be 17 days. Well, now there's a new form out that basically gives the buyer until literally the day we close to back out because of what you're saying, but it has to be directly tied to COVID-19.
Gotcha. Yeah, yeah. We have a attestation form that is signed to that says, your employment is still the same and your income stream is still working functional as
Right.
well. So, yeah, absolutely.
Got it. So what if you are, because we've already kind of talked about, lenders tightening up their criteria, but what if you are under contract? Because like what we have seen is some buyers have just flat out just canceled escrow, but is there anything they need to be aware of?
Yeah, absolutely. So, you know, a loan officer's job is a lot of times is to put is most of it is to put you in a loan program that, it's a box, right? The
Mhm.
it's a small box and you can operate anywhere within that box. Now, if the box changes, it becomes a square versus, I mean, like a triangle versus a square. A loan officer's job is to make sure you can fit within that triangle now. So I think the thing that people who are in escrow now is that a good loan officer is going to review what changed and talk to the underwriters and make sure that the criteria that's being added fits that situation for that
Mhm.
particular escrow. I had that happen. I was doing a refinance, and then there was a requirement that says, "Oh, you need 3 more months liquid." And you're like, "No, I locked this loan 2 weeks before that criteria came out." So a lot of things are grandfathered in too. But
Which is
yeah,
important to know.
right. And a loan officer's job is also to communicate. Like communication's key. If they're not telling you about, you know, this thing or like the extra reserve requirement, it's maybe because you don't need to know it because he's taking care of it already. Um, but if they're asking, oh, I need another pay stub or I need another bank statement, definitely give it to them because they're not asked because loan officers don't ask things just to ask. Like the reason why they're asking is because they need it. They need it to verify something or to make sure the loan is good, right?
Hmm.
So communication, like, if you don't have a warm and fuzzy, your loan officer should be picking up the phone, and they should say to you, "Oh yeah, there is an extra requirement, but don't worry, I reviewed it. You're good." Or, maybe the harder conversation is, "Yeah, the box became a triangle now, and now we got to get you back in that triangle. These are the steps we need to take in order to get you back there." And it's a loan officer's job to come up with a plan. They should be able to tell you how to navigate from that square to that triangle.
Got it. Okay, and that makes sense. So, what do you see happening going forward? Like, because obviously there's a lot things happening, some good, some bad. Unfortunately, a lot bad. But what is your outlook from the mortgage perspective? What do you see is going on?
For us right now, so the refinance like bubble came and it's going away slowly, right? It's not nearly as crazy as it was, 2 or 3 weeks ago. The Fed has definitely done its job and has even today even told consumer confidence that they're doing everything they possibly can. It seems like things are stabilizing. They've been stable for now about a week and a half, I would say. Um, and as soon as this opens up, then all the guidelines are going to be rewritten and relooked at. And I can't say that I feel like people who were qualified before can't qualify now, as in the majority of issues. I would say it's a very small, um, it's a very small amount. So at the pre-approval stage, you had a W-2 or a pay stub or a business and tax returns and things like that. As long as your income remains stable, everything should be fine.
Okay.
Uh, so, in a couple months, or I don't know what the timing would be, but when COVID ends, you know, I foresee it going back to normal. But that's just my opinion. So I'm just a loan officer. Yeah.
And again, literally tomorrow we can get hit with new guidelines or new whatever. Like things change all the time. So I appreciate it. Okay, so this actually went really well, and I appreciate that. So why don't we answer some of the questions, and then I'll kind of dig into what we're seeing in the market. So the first question was, what about giving tenants an option to purchase? If we're going to require them to pay all back rent, why not have that money serve as a down payment? So I guess,
Yeah.
I don't know if you can answer that directly, or maybe maybe it can be exchanged for equity.
Here's the thing is, I think this is kind of in the ballpark of both Rick and I, so I handle the money side, Rick would handle the real estate side. But if you're a tenant and you want to make that purchase, like you can write anything into a contract. And that contract can be accepted or denied or be countered. So, if you owed, back rent of like let's say like 3,000 and the purchase price should be 500, write it for 503 as the purchase price. And that could solve your problem. So contracts can be written in a purchase contract any way, shape, or form, and a good agent and a good lender will work together to make sure that whatever you're doing is kosher, right? But yeah, I mean, you could get real creative with how to do that. I'm actually in that situation right now, to be honest with you. A guy, well, not exactly, but basically the landlord died, not from COVID, but but the tenant wants to purchase, right? And then his family had to get involved, and they negotiated a final settlement price. So yeah, definitely utilize Rick and your agent uh, to figure out what that negotiated price will be, because at the end of the day, the price is going to dictate everything, right? So
And it still has to appraise, right?
and it
So
still has to appraise. Yeah,
so it's
absolutely.
like using your example, it still have to appraise for 503 for it to work.
Exactly.
So
Yeah,
no,
absolutely.
that
Yeah,
makes
hopefully you get a good appraiser and they don't they don't make a $3,000 uh, difference on it. Yeah.
Right. I think the most I've seen, an appraiser didn't get to value. It was off by about $100,000,
Mm.
and the seller actually dropped the price by $100,000.
Yeah, yeah. When you have a low appraisal, as you all know, that number has to be well known to everybody after that transaction. So, yeah.
No. All right. The next question is: do you foresee more foreclosures coming soon?
So I haven't seen any literature so much in terms of foreclosures at this point. It's more everything is going towards forbearance. Now, forbearance says increase nationwide, that's for sure. And I mean, I don't know how reliable the statistics are. LA County, they say half of the people are now unemployed because of the entertainment industry. But most of the literature right now is a foreclosure. Now, it might be a lagging indicator, right? It might be a point when if this thing were to extend, for 6 months versus 3, or people's typical uh, forbearance timeline, then maybe that's when we start running into trouble there. But yeah, let's just hope it doesn't get to that point.
Right. Plus, I think, and again, could be wrong, but it's not like if there are some foreclosures, because there might be, right? Because if you go into forbearance, now you have this big bill, and even if it's not a balloon payment, even if they just raise your mortgage every month, but it's not something you can afford, then that might happen. However, what I am seeing is across the nation, over 50% of homeowners have at least 50% equity.
That's great.
So what we might see then is some homes go to market that aren't foreclosures. They might just say, hey, I'm just going to sell. I'm in forbearance. I don't have to make payments. So I'm going to list it now. Is that something the lender would be okay with? Or is that something where lenders going to be like, nope, you got to give us the bill now?
Well, here's the thing is that, for loan officers, all we do is work with buyers. We don't even see what the seller's doing. We don't even need to know. As long as the seller fulfills their portion, clearing their title report, paying off what they need to pay off, to us, that's transparent to us. For us, it's just about can the buyer perform? Do they have the money and do they have the income? Is really what it comes down to.
Right.
Now, on the seller side, what may happen is they'll say, okay, you need to pay off the first lien, and if there's a second, now you pay off the second, or whatever. Because what happens on our side is what we do is we contact. So the seller will have a payoff statement from that lender. The
Mhm.
lender is going to only release on the title report when they get the money that's on this payoff statement. So yeah. So but don't worry about our side. The buyer side, it's transparent.
But on the lender side, let's say I'm the homeowner and you have my loan, and I go into forbearance and then I post my house for sale. Is the lender going to have a problem with that?
Um, I would. It's not a situation where you're underwater, so I don't think it would be
Sure.
a problem. Yeah, because if you only have like a loan amount outstanding of 200K, but
Mhm.
your home is worth 600K, right? You have 400K of
You're a lender. You're
liquidity.
like,
Yeah.
yeah, go ahead.
Yeah, exactly. Well, you're getting we'll through escrow. The escrow company will take the money that's owed on the outstanding loan, and then they'll give that check to them, the net profits check to the seller, and then so on and so forth.
Okay, that makes sense. And we just got another question is, do you foresee any adjustments to qualifying DTI, which is debt to income, with current employment trends?
To be honest with you, I feel like all the banks and then the lenders have all made their adjustments now. I think it's pretty much finalized. So if you were to get to a pre-approval, your loan officer should be taking these extra, hurdles or, overlays into account and be
Mhm.
giving you a final pre-approval number. A loan officer shouldn't worry you about, hey, well, you need 3 months reserves, and telling that's not necessarily their job is to make your life easier, right? So they
Mhm.
should take that all into account and say, hey, your max purchase price is 500K. You know, go ahead and go find a home, right? Any more adjustments to overlays? I don't see it happening, but maybe, but like I said, like Rick said too, is, things change all the time. But for right now, as far as our company is concerned, the only thing that has been completely shut off, which actually just came back yesterday, was bank statement loans. So like non-QM loans, loans where people are self-employed, they can't show tax returns. So,
Can you explain a little bit more onto what QM means?
oh yeah, quality mortgage. So you can buy basically for in layman's terms, basically just separate loans into regular loans and like alternative document loans. So alternative document loans are when you can't show what normally is required to show. Because you're self-employed, you write off a lot of things. Your income on your tax returns isn't exactly what your income should be in reality, and you find other ways to find that income. So usually what happens is you take all the deposits across 24 months, which is painstaking. You divide it by 50%, and then that's your income. So usually that's how it happens there. So that was shut off for a good 2-3 weeks, but now even they've come back. But the restriction is tighter than it was before. Like
Sure.
they're requiring like 30% down type of stuff going on there, just to make sure they protect their investment as well. But yeah, I think everything's pretty much stabilized. If you asked me like a week and a half ago, I would have told you I have no idea.
Okay. That's all really good. So I see one more question. Do you see house prices will be in a downward cycle? I'm actually going to touch on that a little bit. I don't know, John, do you have any initial thoughts on that?
No. You're definitely more of an expert on that side than I am.
So let's kind of go ahead and dive into that. There's a couple things I want to show. So let's start with, we're going to share the screen. We'll start with a little history lesson. So we'll go to share. All right, so hopefully you guys see that. It says a history lesson, recessions in real estate. So this right here, the first chart, shows what has happened over the last 5 recessions. So in the last 5 recessions, only twice did we see price reductions. One of the things you have to keep in mind with real estate is it's a necessity, right? You have to have a roof over your head. So, and what happened in 2008, whole nother ballgame. People were getting loans that really shouldn't have. And then in 91, it went down by 1.9%. Why that happened, not 100% sure, but it's such a small amount. It may have just been part of a cycle. The other thing to keep in mind is when it happened in 2007, 8, 9, on average across the United States, prices dropped about 10% of the worst, whereas the S&P dropped 51%. Part of that is because as the stock market goes down, a lot of investors are going to say, hey, I don't want to keep losing money. So they pull out their money and they have to reinvest in something else. So that usually comes real estate. They're like, all right, I'm going to pull out my hundreds of thousands of dollars and plop it somewhere else. I saw there was a lot of condos for sale at one point, and I kept looking at the owner, and it was the same owner over and over again until I realized, oh snap, they bought in like 2009. So when the market crashed, they bought up all these condos that were in foreclosure, and they were just renting them out, and now they're back for sale. Then the last thing I want to show is, because what's happening with COVID is it's because of a virus. The state of the economy is because of a virus. It's not because of something necessarily we created. So let's take a look at 2 things that may not have been directly impacted. First would be the dot-com boom and bust, and the 9/11 crash. So what we saw is, again, there's a correction in the stock market because it's very driven by emotion, but home prices still continued to go up. Like we saw a little bit of a blimp, in 2001 at 6.6%, but it went right back up to 8.5% by 2002. So we see a lot of that. So it's one of those things where, depending on who you are, most experts are saying one of 2 things is going to happen. Either nothing's going to happen, which is the majority, and the reason being is because inventory is so low. As John mentioned earlier, so many people are refinancing. So if you imagine, if you own a house right now and you've owned it for 10 years, because home prices have gone up, you might not even be able to afford the house you own. So for most people, it makes more sense to refinance than it would be to buy something else, which in turn means I'm not putting my house for market, right? So they're better off just staying put. I have a lot of clients like that where I keep trying to talk to them and say, hey, look, here's what your home's worth. And they say, but Rick, yes, I get it. My home could sell for 800,000, but where am I going to find a almost 2,000 square foot house with a pool, great area, with an accessory dwelling unit for less because their payments are so low? So we're seeing that. Others are saying if there is a drop, it will bounce back with a vengeance because there's a lot of pent up demand. There are a lot of buyers that are sitting on the sidelines right now waiting to buy, especially here in LA. On literally 2 days ago, they made the announcement that we can now do showings. So for the last month, we were not allowed to do any showings in the city of Los Angeles. So you have all these eager buyers, all these eager sellers that couldn't make a deal happen. The other thing to show, and I'll pull this up here, this is one of my favorite tools called InfoSparks, but they actually pull data from the multiple listing service. So this is month supply. What that means is if you took, we'll take what happened in March. This is 2.2 months. So no new homes came to the market, zero, nada. Just what's on is what's there. It only takes 2.2 months for it all to sell, which is very fast. Anything below 6 months is a seller's market. Anything above 6 months, right, 7, 8, 9, 10, 11 months would be a buyer's market, right? Because there'd be more buyers and sellers. So the issue here is in order to create a balanced market, we would need almost triple the inventory just for it to be a balanced market. So that's where it becomes more likely that it's going to be sticking with sellers. Now, what will be interesting is effective May 1st, there will be no more legal pocket listings. So what does that mean? It means homes in the past could be sold off market, right? So they weren't actively posted in the multiple listing service. I've sold many properties that way. And oftentimes it's for privacy reasons, convenience, whatever it may be. But now, if a realtor does any sort of advertising on a pocket listing, they have 1 business day to post in the MLS. So that might change things as well. There might be more homes on the market than we had before. So that's kind of the facts that we're seeing. So in general, are we seeing home prices going down? It's unlikely you're definitely not gonna see anything that happened in 2008. That's very unlikely to happen. If we do see any drops, it'll be like this, but it may bounce back with a vengeance. Hopefully that answers your question. So let's see what we have. We have another question. If you have the money reserves and you have the income, but you're unemployed for the last 2 months due to COVID, but you get a job again, how does that affect your approval if you need 2 years of steady income?
Yeah, so the mortgage industry standard is that you have to have a 2-month or a 2-year history in total before you can get a loan. So college includes employment per se too. So usually it's a problem if you are out for 6 months is when it kind of gets dicey. But 2 months is not a very long time. If it's a conforming loan, if you're a W-2, if you wasn't self-employed before, you're just going from a W-2 to a break because of COVID to a W-2. I don't foresee that should be a problem at all. I mean, everybody knows what's going on with this COVID thing, and I think there's a lot of it's not because you proved to be have an unreliable income stream. It's not like you're changing jobs, again and again and again, and you can't hold a steady paycheck. It's just because of a national crisis. So if it's in that criteria, I would say that's probably not a problem at all. But here's the thing: is conforming loans are, Fannie Mae, Freddie Mac, FHA, VA. They all play by the same rules. Now, if you get into the jumbo world, which is in LA County, is basically 765. If your loan amount's higher than that, 765K. Then everybody jumbos write their own rules. So that's kind of where it's the Wild West, where a good loan officer has to place you in a place where that shouldn't be a problem. But I can't imagine that would be something that they could hold against you. It's just because, maybe you need like a letter from the employer saying, hey, you got hired and you have a steady paycheck and we expect you to be here for the next 3 years. That should be fine.
You brought up something interesting. So there was an article that came out, I think it was a few years ago, saying millennials are known as the job hoppers. They're known to get new jobs all the time. How does that affect the loan process? Because
Yeah, we're all mercenaries, right?
yeah, right.
um, I don't think you can fault someone for job hopping. I mean, in my personal opinion, now may it look, not displeasing to an underwriter that maybe, if you job humped like 4 times in the past 2 years, that may be an issue. But usually, if you're a W-2 employee and then you have a agreement of employment and you have pay stubs showing that you've been in the same industry for the past 2 years at least,
Mhm.
you just happen to switch jobs, you should be fine. I mean, to be honest with you, like, even if you have Fannie Mae current guidelines right now is even if you have an employment agreement and your future date of employment is set, and there's an employment letter that's signed that says you're going to make 100K per year, you can even use that too. So, as far as current guidelines go, right?
Right.
But yeah, I mean, I don't. It normally isn't a problem. Now, if it's too much, it could push it over the wall. But yeah, it shouldn't be a problem.
Okay. That's awesome. So that's everything. So if anyone has any last minute questions, go ahead and post them in the group chat. As a recap from earlier, this is being recorded, so we'll send out the recording once everything's all done. Things do change day by day. So everything we've talked about today could literally change tomorrow. I mean, John even mentioned there was things that changed yesterday. So know that, and of course, everyone's situation is different. So if you do have specific questions about your scenario, feel free to reach out to me, feel free to reach out to John, financial advisor, tax preparer, all those type of people, because everyone's situation is different. We will get through this. It's just a matter of not if, but when, right? And when we get through this, we'll get through it better, stronger than before. So, John, how can people get a hold of you?
Oh yeah, I'll type my contact information here, and then I'm always on my cell phone. I always pick up, even on weekends, at night. I pretty much work all the time.
Yeah, to
So
make anyone feel better, it's true.
yeah. Yeah, so you can always shoot me an email, and it'll all work out at the end of the day.
Perfect. And if anyone needs to get a hold of me, you can reach out to me through social media at @RickBAlbert. I will be shooting everyone an email with the link, so you'll have my contact information there. All right, everyone, stay healthy, stay safe, and I'll talk to you guys soon. Thanks, John. Appreciate it.
Yeah, thanks you, Rick.
Hey everyone, hopefully you liked the video. If so, please don't forget to give it a like, maybe show some love in the comments. Also don't forget to subscribe. We do have other videos posted. Please go ahead and watch them, enjoy them. They'll be posted somewhere here. Feel free to click or just view the channel in general. Thank you guys so much. I'll see you next week.